Welcome. My name is Adam Rundle, and I am the co-founder and CFO here at Lucro. And today I want to share with you the perfect P&L methodology, the exact methodology and framework that we use and implement into every single one of our clients' financial systems to help them drastically improve profitability and long-term sustainability. So let's dive in. The perfect P&L is all about optimizing profitability in your business. The reality is, and whether you like it or not, you're in business to make money and to personally make money. This is truly the only way that you can guarantee your ability to treat your patients, to provide for your staff, in terms of quality employment, as well as to impact your community long term. For you to do that, you need to build a business that is optimized for how much money you can earn as the business owner. Because once you get that right, you can almost guarantee that everything else in your business is working and working efficiently. So from an overview standpoint, that's what we want to achieve. We want to optimize for profitability, but how do we do that? Well, we do that by making informed decisions as consistently as possible about how your business is performing. That is what effective management is the ability to make those informed decisions. And we believe there are kind of three subcategories when it comes down to building a system and a structure that enables you to make those informed decisions. And the first is the structure and allocations, the understanding of the key drivers. How are those different areas interacting with each other, and how does that drive performance in your business? And then ultimately analysis. What does this actually mean? Is this good? Is this not good? And then how do we then take that and actually build a framework around decision making so that we can apply that to make those best possible decisions as often as possible. So the structure is a simple profit and loss structure. Performance of your business is really centered around your profit and loss statement. Not saying your balance sheet and cash flow statement are not important, but when we're looking at performance, we ultimately are looking at your profit and loss statement. And here we are looking at a particular structure that we use here at Lucro as part of the perfect P&L in order to give us the insights we need and the KPIs we need in order to analyze performance. So we're building a structure that not only does the accounting process that generates your profit and loss statement, but actually gives you way more functionality in terms of decision making around how to improve the performance of your business. So at the top, we have the sales figure, which is all revenue generated from any activities that you have in your business. So it doesn't matter what type of revenue it is, it's all going to flow through our sales category. There may be some subcategories, but it's all going to flow through sales. Then we have what we call cost of goods sold. These are costs that are directly related to the selling of those goods. Merchant fees is the most common one, and then any directly related supplies to the patient. So if you're doing neuropathy, for instance, you may be giving them a home care, a home package, which includes supplements. Those would fall under cost of goods sold. So those are direct supplies that actually go to the patient, not just consumables in your practice. Those fall down below under our overhead section, but direct costs that actually are transferred directly to the patient. We then have a gross profit figure, which is kind of a sum of the above, and I would deem that is the actual revenue generated from your practice. That's the amount of money that ultimately flows into your business that you will then run the rest of your different expense categories through to then determine profitability. We then have four key categories that we break down our business P&L into. So the first is marketing. These are all costs associated with marketing and acquiring new patients. So anything that you are doing that has a cost, that brings new patients into your practice so that you can either do your day ones, day twos, and you can revert them. They can become longer term patients and do care plans. But anything associated with marketing would fall under that category. We then have our labor category. Now this includes all costs for labor. So whether they're contractors, whether they're W-2, any human resource that we have in our practice would fall under the labor category. We then have practice costs. These are the costs that are associated with the physical space from which you operate. These are usually pretty immovable and they're usually fixed in nature. You can't just up and leave next month out of your rental space. And so we're looking at rent, utilities, maybe some security costs, parking costs. And they're very important for us to analyze because they are harder to move. They're relatively immovable and they form an idea around, well, how much do we need to be generating just to cover the physical location from which we operate from. And then the last category is what we call our overhead category. And this is pretty much everything else that you are spending in order to run your business. So all the other costs that are not included anywhere above that you are incurring in order to run your business, whether it's software, consumables, supplies, bank charges, whatever they may be, they will fall under the overhead category. And then ultimately we have the most important number that we believe in is our profit number, which is taking our gross profit less all these expenses. And that is the profit that you can generate from running your business. Okay, now we're going to move on to allocations. So we understand, if I go back a step, we understand the structure. Okay, this is how we're going to allocate all our costs accordingly. So every single cost that comes through our business is going to go to one of these categories. That's great. We now need to identify, well, what should they look like? If I now allocate them, what is the ideal range where I want these costs to end up in any given month? And so the way this works is, if you look at the top there, it says mostly adjustments. There are two primary models that we use here at Lucro, and the one is the mostly adjustment model, which means you're deriving the majority of your revenue from doing actual adjustments with your patients. The other model, and I'll just skip to it, is called the minimal adjustment model, and that's doing mainly treatment protocols like neuropathy or decompression, where you're doing not a lot of adjustments, but you're doing a much higher level of those different treatment protocols. Now, these are ultimately the extremes. So this is the mostly adjustment model when you are purely doing adjustments. This is the model where you are pretty much purely doing treatment protocols or niche treatment care for your patients. The reality is most of us fit in the middle somewhere, which is perfectly fine, but we just want to understand the two pillars from when we can operate. And then we break it down into a monthly revenue band. So the first one is $50,000 a month in revenue, then 100, 150, 250, 500. And wherever you are, you will either fall directly on a band, or you'll maybe be slightly between a band. And it'll give you an idea of what your cost structure should look like at that different level. And the allocation is simple. So if you're generating $50,000 a month in sales, we would expect you on the mostly adjustment model to spending no more than 3% on cost of goods sold. And that would stay consistent right the way throughout, because the majority of the costs there are just merchant processing fees. Because we're not technically supplying anything to our patients, mostly we're coming from adjustments. Our merchant processing fees are somewhere below 3%, so that falls part of our cost of goods section. Then the sum of that falls part of gross profit. Then the next set of percentages are actually derived off our gross profit percentage. So the profitability is a little bit different, but we're now saying 10% of that gross profit number we would want to allocate to marketing, no more than about 25% to labor, 7.5% to our fixed practice costs, so like our physical location, and then 12.5% to our overheads category. And that changes, as you can see, if you scale, let's say, use the $250,000 band. Here we're looking at a little bit of a higher, so a 15% marketing cost, a much higher labor cost, because our volume is significantly higher. Therefore, we need to employ more people in our practice in order to cater for our volume. So we're looking at about 40%. Our practice costs usually decrease over time, so that we're looking at about 4.5%, and our overhead have a slight increase in nature over time, given the size of our practices. We're looking at about 15.5% to ideally give you around that 25% profit margin. And so as you can see, maybe around $50,000, we would expect a profit margin of around 45%. It will decrease over time, but you are obviously generating significantly higher levels of revenue, so you are still making more money as you are scaling and growing your business. The major caveat here is what's included in labor and what's excluded in labor. These labor numbers do not include the owner's salary. So if you're the owner and in a chiropractor in your practice, we would exclude owners' salaries when we are doing analysis and identifying what your perfect P&L looks like. The reason we do that is simply because owner salaries are very hard to measure across the industry, because everyone is doing slightly different things, and mainly for tax purposes, which makes complete sense. So we found it much easier just to remove owner salaries when we're doing all our research and analysis and trying to figure out what are the best practices doing. And we identified that if we remove owner salary, we get a way more consistent view and a much more realistic view of what is actually happening in the industry. So the exact same applies on the minimal adjustment model. However, the model is just very different. As you can see, we have a much higher cost of goods sold number because we are supplying more items to our patients to take home, whether that's neuropathy or whatever it may be. So we naturally have a much higher cost of goods sold level, which means our gross profit is lower, which is simple math. And we also find that our structure, particularly around marketing and labor, is very different to that of the minimal number. So I'll just flick between the two. And as you can see, marketing scales to a much higher number, up to about 25% at the top band, where it only goes to about 15% at a lower rate, so it scales slower, up to 15% in the mostly adjustment. But then the minimal, you'll see there's a bit more of a flat line with labor, 20, 20, 25, 30%, where we have this much bigger increase in labor in the mostly adjustment model. Overall, the profitability is very similar. There's very minor differences in the overall profitability. It's just the makeup of the model is very different. And it makes sense because the more adjustments you're doing, the more people you need to employ, which means your labor cost will take up a higher percentage of your overall cost structure. So I've also provided you with what we call the blended model. This is just blending the two together. So if you are doing both adjustments and minimal adjustments, so you're doing niche care plans like neuropathy, you may want to look at a framework like this where there's a bit of a band to follow, because you're going to fall somewhere within the band depending on how much you are doing in adjustments and how much you're not doing in adjustments. So it's just very helpful to have a look at an overview of the different bands. Then we're going to move on. So as I said, we're going to allocate everything. So we go back here, we allocate all our costs. Then we just simply run a percentage calculation saying, well, if I spent X amount on marketing, what percentage of that was a gross profit? And now we can test that against our allocation model to say, hey, are we where we want to be? Are we spending more than what we should be spending? Are we spending less than what we should be spending? And then what does that mean? How does that enable us to make decisions, which we'll get to? But that's the allocation, the structure and the allocation framework gives us the ability to start to identify what is actually happening in our practice. We're then going to look at the key drivers. And this is really important because a big mistake people make is when they do this analysis and they see that their marketing is way too high. So their marketing is 15 or 20% at the $50,000 band, and they go, oh man, my marketing is a problem. Instead of jumping straight to marketing, we need to understand what are the key drivers in our business that are actually driving the outcome of our finances. Because yes, you may see it in the marketing metric, but it could be another area of your business that actually needs focus. And so here we just break down, and you can kind of read the screen or pause here. I'm not going to dive into all of them, but obviously revenue is hugely important. It gives us the different bands from which we operate, and they scale and move as we go, as well as whether we are mostly adjustment or minimal adjustment. And also it helps us understand a misalignment. Because it sets that framework, we can immediately start to see a misalignment between what's happening on our expenses and what's happening in our revenue. Cost of goods sold is obviously a direct relation to the consumables that we're giving to our patients, and this is a massive focal area in pricing. Your cost of goods sold should never ever really go much higher than 20%, and if it is, it means that we clearly have a pricing issue. So yes, you can say, oh, my cost of goods sold are bad, but actually the underlying problem is a pricing issue, and less so than what the cost of your actual goods are. Obviously, you could always maybe get them cheaper or whatever that may look like, but the actual driver here is revenue and pricing more so than the cost of goods sold. We then have marketing. Obviously, without marketing, we cannot attract new patients. And this is about measuring how effective is our marketing. Are we effectively spending money in the right areas, and are we getting effective return for our marketing? Or are we spending money in ineffective areas and we're then getting a poor return for our marketing? And we need to understand this so that we can work out how much money we can spend to acquire new patients. Probably the most important marketing number that I believe in is not how much you spent on marketing, is how much can I spend to get one new patient to walk through the door. If you can understand that number, and there's other trainings on that and lifetime value of patients, but if you can understand that number, you can optimize your marketing structures in order to improve, to get people into your patient for cheaper costs, which is going to be way better for profitability long term. Labor is obviously the most important area in our business. When I say important, that the most significant cost structure in our business, because our staff ultimately drive how we treat our patients. So understanding that breakdown, and if we are generating sufficient revenue to support our labor costs, is extremely important. And it's a massive capacity calculator. It helps us understand capacity, and are we running at capacity or not running at capacity. Obviously, if we're not running at capacity, then we're just simply losing our ability to maximize profitability, which is really silly. And then we have our practice costs. Because these are fixed, our ability to decrease them over time is very limited. So it's really important to understand what is kind of the minimum amount of money that a practice should be generating just to cover its fixed costs, to ensure that it is going to be sustainable in the particular location that you have for a long period of time. And now we can move on to analysis. So we've got the framework. We've got the structure in place, we've got the allocations, we understand where everything goes, we understand how the key drivers interact with each other. Now we can actually do analysis. So we here at Lucro, what we do is we give analysis points on 7 key areas. The first is income, then marketing, then labor, then overheads, profit, cash on hand, and trend. and we are comparing what the targets are that we have set for that particular month. So in this case, it was $450,000 a month. We understand what the targets are for each operational area and between marketing, labor, overhead, and profitability. We also have identified what is the ideal cash on hand level. And then we are comparing that to the actuals. So as you can see, the actuals in the next column. And then we are giving it a rating and saying, okay, we are only at $413,000 a month in revenue. We've given that a neutral rating. So there are 4 ratings. There's positive, neutral, warning, and caution. The neutral rating is simply saying we are as expected. And it's not too concerning at all. We are achieving pretty much so what we set out to achieve. This is our revenue number is a little bit lower. However, we are setting a target of $450,000 a month, so it's a really big number. We will then give you some commentary on what is actually happening in that area and what we need to be thinking about. And so as you can see, and you'll look through, you'll see that in overheads are positive. We're only at 13%. We want to be lower than 20%. That's a really good number. Labor, however, it's a bit of a warning. We're not cheap. Our number is too high. We want it to be around 40%. We're currently at 47%. What we've identified is that maximum capacity or maximizing our capacity is closer to the $450,000 income levels. So anything below that, we start to fall under pressure from a labor metric standpoint. And then the same thing with cash on hand. Ideally, we should have over $600,000 cash on hand in a practice of this nature. We only have $140,000. So we're giving that a warning. We're saying, hey, we need this to improve over time. Otherwise, we're going to create unnecessary pressure on the business. We also do a lot of work around trend analysis. Unfortunately, it's not in these slides, but trend analysis is looking at the previous 12 months and seeing how is the business trending historically, which is really a good indication of what we could expect going forward. And then ultimately, it's led to decision making. So at the end of the day, what we want to do is make the best possible decision. So now we have a structure, we have allocations, key drivers, we have analysis, we have all these tools, and now what we need to do is a very, very simple 4-step process. The first is we use the metrics to triage what needs our highest area of focus. Thankfully, we do that for our clients in just a simple triage system like this with colors. We now know cash is the most important, then labor, then we're going to look at income and trend, and then we'll focus on the positive areas. The next, we need to determine, well, what are the key relationships that we need to be considering in order to improve those different areas. So just because, and we've said this before, just because cost of goods sold is high or just because a certain area is high, it doesn't mean that is the only reason. We've got to understand the key drivers in order to determine what do we need to do, what action we need to take in order to improve the ultimate outcome. We then need to, number 3 is determine what are the action steps and what are the decisions that we need to make in order to improve. So we list them down. Okay, we're going to spend more money on Facebook marketing this month, or we're going to go do some more dinner seminars, or whatever it may be, whatever those different decisions may be, we will make them. And then most importantly, number 4 is we need to implement them. We need to take action. We can't just look at the decision on a piece of paper. We've got to take action and then consistently review the metrics to determine, are we actually achieving a positive outcome? Are we shifting in the direction we need to shift to? That is why we fundamentally believe that every single month we will always give our clients this report by the 10th of every month so we can consistently track how are we performing. So are those decisions actually yielding a positive return, or do we need to adjust them or make better decisions in our business?
There you have it, the perfect P&L methodology. The exact methodology and framework that we use to help manage every single one of our clients' financials. So if you're interested in working with us, please reach out, as we would love to have a conversation to help you take your practice to a whole new level.